I think back in March, we were talking about the sell-off being temporary. And of course, we're now in late May, and here we are, the S&P is up. And actually, we talked about software, and software is up. AI software in particular is up about 12% for the year. So yes, I think the reasons are still plentiful to continue to stick with stocks. And, Tom, one of the things you have to do is you'll have to look at the economy. And while the sentiment around the economy fell apart, the hard economic data never did. So as a result, we're still looking at 2.3% GDP growth this quarter when everybody was worried about the tariff impacts. So that's the first thing. The second thing is the determination, you just heard from Peter Navarro, to cut those deals and continue to negotiate is absolutely there. So as long as that's the drumbeat, then I think we have to discard any sort of data that goes against that. And then the last thing I would say, Tom, tomorrow we get the core PC inflation report, which is projected to be about 2.5%. Yep. And whether it's oil prices that are lower, whether it's wages that are lower, all of that is supportive. So I still think investors are not tapped out. It's not max bullish by any means. So I think we add here.
Ivan brought up the 3.x trillion of cash, Paul, out there.
Yep. It's always been out there. I mean, earlier this year, it was out of the U.S., out of cyclicals, out of tech. Now it seems to be, if I look at the S&P 500, if I look at NASDAQ, it seems to be that trade's getting reversed here. People are investments coming back to the U.S., back into cyclicals, back into tech. Was it just what was that?
Well, there's a lot of discussion around that. And first of all, the month of May has all been about these stark reversals back into the U.S. tech and back into the U.S. And back into cyclicals. But if you actually look at the performance here to date, it's the defensive sectors like utilities, for example, that lead the S&P. They're up about 5 or 6%. The semiconductors, for example, are down about 5 to 6%. So I don't think it's actually too late for this rotation trade. And look, we were never in the camp of the U.S. exceptionalism being over, because what's not over, for example, is the fact that we have one of the most constructive tax policies relative to our developed market peers. The fact that the corporate tax rate in the U.S. is 21%, and with some write-offs, maybe the effective one is even 18%. That is a very constructive environment to do business in the United States. And obviously, that's what the administration is trying to foster through tariff policy as well.
Do we have to bring the valuation discussion back on the table? Because, boy, when the market sold off, a lot of folks are saying, boy, 18 times earnings, I'm going to go in and buy this thing. But now we're back, above 20 times. How do you think about earnings? Because there still may be some earnings risk in this market.
Right. So a few weeks ago, we sort of had, when we didn't know what is likely to happen with tariffs, we sort of had this binary risk. We either have to price in a recession and therefore recessionary earnings, which could have taken us, well, it has taken us as low as 5,000, but could have taken us lower if we also had to assign a recessionary multiple. Now, we don't have to assign a recessionary multiple, and we actually have to focus on the earnings not only this year, but next year, which are expected to be around $307. So if you apply the existing multiple to that, you actually do get north of 6,000 on the S&P 500. And that's why, to Tom's point, I say large cap stocks are certainly worth staying with.
What does free cash flow look like in use of cash? I mean, back when you were lonely and correct, the answer is the free cash flow came in. And I'm hearing a lot of fancy, well, it's not going to be this first, second derivative, da-da-da-da-da. Do you see sustained free cash flow by the market leaders?
I mean, look, I do. And the use of free cash flow, I think, certainly would benefit the share repurchases and buybacks. And, Tom, that's what we're seeing in the market. We actually have some of the record authorizations for corporate buybacks. And that is such a strong presence in the market as well, which is why I say market participants are not tapped out. It's individual investors, it's hedge funds, it's CTAs, but it's also corporates buying back those shares. Look, the beauty of the setup, Tom, is that corporate margins are near highs. And so there's a lot of room to absorb the potential negative impact of tariffs.